Dear students, welcome in the class of Fundamentals of Economics. In today's class, we will discuss about the taxes, the meanings, the types, and agricultural taxation systems. So, myself, Dr. Shailesh Kumar Singh, will be with you for next 20 minutes, and we will elaborate about various type of taxes, direct or indirect, and the agriculture taxation system with exemptions. Taxes, we all are aware that it is a compulsory contribution, means the contribution which is essential, which is necessary, and is necessarily levied upon a person or any corporations or institutions. Why? Because this is a means of revenue for the state and central government. The revenue that is going to be generated from such kind of taxes are utilized for development of the country, either it is infrastructure development or health related development or education related development. So all socio-economic development of a country are dependent to the taxation system, the income or the revenue generated from this taxation system by any government in the country. Many taxes are related to central government, some are related to state government, some are being distributed among both of these government. So we will discuss these different kind of taxes. The taxes can be classified in four major categories: the proportional tax, progressive tax, regressive tax, and digressive tax. This classification is based on the how the taxes are going to be affected on the basis of increase or decrease in the income. The first, proportional tax, is, so the terminology itself is sufficient to make it clear that the taxes are depending on the income generated, and it based on the proportional difference between them. So same percentage is going to be on the tax system. So as the income increases, the amount will be increased, but there will be no increase in the percentage of tax. So the percentage tax is irrespective of size of the income. However, since the percentage is fixed, suppose that X percent, Y percent, whatever percentage is there, but the percentage is fixed. So as the income is going to be increased, the total amount of revenue generated from that, or the total amount of tax collected from that income, will also increase without changing the percentage of tax. And one of the good example is sales tax. It is imposed by the government at the point of sales on the retail goods and services, and is being collected by the retailers, right? So this taxes which are collected by the retailers are passed on to the state, right? So 8% sale tax rate means on 1000 rupees it will be 80 rupees. On 2000 it will be 160 rupees. So as the value will increase, the amount of tax collection will increase. Although the percentage tax or tax rate has not changed. So the tax rate is going to be irrespective of the size of the income. The second is the progressive tax. So it is a kind of tax burden over the higher income families and is lower, or it reduces on the lower income families. So the terminology progressive itself indicates the tax rate, the tax bracket is going to be higher if the income is going to be increased, right? So the amount is going to be increased, the tax amount is going to be increased in many-fold. One is due to increase in the income and the second due to increase in the tax rate. So greater the income, higher is the tax. So income tax and sale tax on luxury goods, these are examples, and it is showed that why it has been made this kind of tax, because those who are getting high income will have to contribute more to the country development. Luxury goods, since these goods are generally preferred by the high income people, and so they have to pay more sale tax over this. This table is clear-cut differentiation between the proportional and progressive tax. Here you are observing the tax base is 1000, 2000, 3000 rupees. So these are the income, you can say in another way, and the tax rate in proportional is fixed 10%. But although tax rate is fixed, but the amount of tax is going to be increased from 100 to 200 and 300 so on because of the increase in tax base income. But if you are comparing on the progressive side, the increase is in many-fold. You can observe that on 1000 on 10% tax rate, it is 100 proportional tax and 100 progressive tax because the tax rate is same. But as the income and increase 2000, the tax rate in proportional tax is still 10, and so the amount of tax is lesser 200, while it has become 15 in the next bracket. Means there is a 5% hike in tax rate when the income has doubled. So this has increased the amount of tax to 300, while when again 1000 tax base has increased, the tax rate has increased from 15 to 25. So again very high, vigorous hike, and is resulting the greater amount collection as 750. So it is very clear how this proportional and progressive taxes or tax rates are varies with each other. Another one is the regressive tax, and this tax decreases as the tax base increases. So it is very clear that tax rate is going to decrease as the tax base is going to increase, right? So in this case it is very clear that those who are getting higher income side will have to pay relatively lesser tax because of the decline in tax rate, right? So this decline is responsible to reduce the total tax burden. So here what the low income categories are the more affected people, right? Means those who are having lower income will have to pay high tax, while those having higher income, even although the tax rate will increase, but this increase in tax rate is very less. So such kind of variations are going to create burden over the low income people. So taxes on necessary are regressive because they are going to take away greater percentage of lower income as compared to higher income. So the necessaries items are facing such kind of problem as digressive taxes. These are the type of tax in which people with low income will have again to suffer with the high, you can say, taxes, while those with high income will have to pay less tax percentage, right? So as the income is going to be high, the tax percentage is going to be low, right? So they are in the win-win situation in comparison to the low income group. So higher income group do not make due sacrifice like that. The tax is although progressive, but it is very mild, so it does not affect over that. It has not affect over the high income categories. This because this increase is very mild, but in that mild increase, this income is relatively very high. So a tax is progressive up to a certain limit, and thereafter it becomes uniform, right? So affect the poor, then rich again. It same. Compare it here very clearly, like as the tax base has increased from 1000 to 4000, in regressive it has reduced. Means for first 1000 you have to pay high tax, for next 1000 you have to pay less tax. And next, as the next amount of tax base is added, the tax rate is going to be lesser. Although total amount is increasing, but this total amount is due to increase in the total tax base, not due to the tax rate. Tax rate is going to be reduced. In digressive tax, although tax rate is increasing, but the magnitude of increase is lesser than the increase in the tax base, like 1000 to 2000. So here only 1000 has increased, but 1% rise has been absorbed in the tax rate, while in the next again 1000, so 1, but in the next level 3000 to 4000, even the 1000 has increased, but in the tax base, but the tax rate has still remained constant. So this means what? For getting first 1000 you have to pay 5% tax, but for getting next 1000 you have to pay only 1% of additional tax. So this is what indicating that the rate by which the tax base is going to be increased, your tax rate is not going to be increased with the same ways. So this is what kind of called as digressive tax rate. So in both regressive and digressive tax rate, at each and every increase in tax base there is increase in tax amount, but this increase in tax amount is very less, because in regressive due to decrease in tax rate, in digressive due to increase in tax rate with diminishing rate with declining rate, right? So this is how we can differentiate between the regressive and digressive rate of taxes. Now we will discuss about the direct and indirect taxes. The direct taxes are non-transferable taxes, as it is paid by the taxpayer to the government, while the indirect taxes are transferable taxes, and here the liability to pay can be shifted from one to another. In direct taxes, the liability is shifted to the taxpayer, while in the indirect taxes, the liability is shifted from one person to another person. So income tax can be one of the direct tax, while value added tax is one of the indirect taxes. The direct taxes are what? They are paid entirely by taxpayer directly to the government. Income tax is one of the best example, right? It is defined as the tax where the liability as well as the burden to pay in the resides pay it resides on the same individual. Mean the individual who is responsible for tax payment, the burden is on the same liability as well as burden will be on the same individual, while direct indirect taxes the collected by central government as well as the state government according to the type of tax levied over that. There are many taxes, and it depends on the government which part is belongs to which either central or state government. The indirect taxes are little different from this, we will discuss, but the major types of direct taxes will include income tax, corporate tax, wealth tax, state tax duty or gift tax, even fringe benefit taxes also. So income tax is going to be levied on and paid by the same person according to the tax brackets as defined by the income tax department. So right, the tax bracket is going to be defined every year, and we know that the income tax is being paid by the person who is working, earning some and earning from any their work or from the institutions anywhere as like the income tax, corporate tax is also a direct tax and it is paid by the companies or corporations on the profits that they have made through their activities. Wealth tax is levied on the values of the property that a person holds, whatever the wealth that one person holds with in terms of the you can say the uh, houses, flats, vehicles and all this. State duty is again paid by the individual when they get or receive some inherited properties with them. And gift tax is generally when anyone takes the giftable tax that have to pay tax to the government. Yes, it may be a player winning some gift from any organization or any place, or they are getting winning some money in form of the you can say man of the match or whatever there is. So fringe benefit tax again is a tax which is paid by an employer that provides fringe benefits to the employees and is collected by the state government. So whatever the benefit is going to be provided by an employer to the employees, so that is the fringe benefit. And indirect taxes are those taxes where the liability to pay the taxes is going to be shifted, and the burden is going to be distributed over the others also. So that's why it is indirect kind of tax. So excise duty, so the manufacturer is going to pay the excise duty, and the tax burden is being shifted over which to the retailers, wholesalers, right? Because they will include that tax that they have paid in the cost of the product. Sale tax, it is again paid by the shopkeepers or retailers, and but it is going to be transferred to the customers or consumers, because ultimately the sale tax we are going to pay over that goods and services. Custom duty, so it is a kind of import, it is import duties, that duties levied on the goods which we are getting from outside the country or any organization is getting from outside country, and where these custom duties are going to impact to create impact over the consumers or retailers who are going to purchase that goods. They have to uh, pay that tax, because the custom duty itself is going to be added in the cost or price of that commodity. So this is what entertainment tax. So it is a liability that is being given over the cinema owners, but it is going to be transferred over the cinema goers. Those who are going to see movies have to pay that tax, because that tax is going to be added inside that receipt, that fee, whatever they are paying for the viewing a movie. Similarly, service tax that is going to be charged to the consumers on the food bill or in a restaurant or any places, but it is going to be paid by the restaurant itself. So actually this is the commodity tax, and it is paid on the expenditure level. So indirect tax are generally based on the expenditure level, while direct taxes are based on the income level. So this is what between these two, and the comparison can be made on the basis of this tabulation. So it is direct tax where it is levied on income and activities conducted, while that indirect tax is levied on the product or services rendered. The burden of tax cannot be shifted in case of direct tax, but in case of indirect tax, the burden is going to be shifted, rather it's going to be distributed. So the directly a person is going to pay that who this tax, the concerned person is going to pay this tax. However, in indirect taxes, it is going to be recovered from the other person, right? So actual bearer of the tax is the consumer. So indirect taxes are going to be paid after the income reaches to the hands of taxpayer. So it is based on the income, while indirect taxes is paid for the goods and services which is going to be reach to the taxpayer. So direct taxes, it is really very difficult to collect it, but indirect taxes, since these are going to be distributed, it is being included into the bills, it is going to be included in the cost, so it is very easy to collect it, right? So many examples direct taxes, as we have already discussed in the previous slides. So these are some taxes. Agriculture taxation system is a little bit different, and we all are aware about that. The agriculture income is exempted from any kind of tax in India. So a taxpayer in India is exempted under the section 10A of the Income Tax Act 1961. So in the Income Tax Act 1961, under the section 21A, the agriculture income has been defined as below. The agricultural income are those income which are included in these three parts. First, any rent or revenue derived from the land which is situated in India and is used for the agriculture purpose. Means any land which is used in the agricultural purpose, if you are earning rent over that, this rent or revenue, any income generated from such kind of land is considered as agricultural income and is exempted from the income tax. Any income derived from such land by doing agricultural operations or by doing processing of agricultural produce, right? So it is including both those which are going to be produced through the agricultural operations, or those which are utilizing this agricultural produce for the processing purpose, right? So any income attributable to a farmhouse subjected to satisfaction of certain condition is specified in this regard in section 21A. So means the income which are attributable to a farmhouse where the activities related to the agriculture are going to produce some income or going to generate some income, that all will be considered under this exemption, like nursery related activities, even like you are going to grow seedlings and saplings and you are going to sell it that is also going to be considered as a. However, there are many confusion in also, and this slide is going to make it very clear. If a person sells a processed produce without carrying out any agricultural processing operation, the income will not be regarded as agricultural income. Means those who are processing without carrying the agricultural operations, that will, or without carrying that processing operation, will not be considered in this agricultural income. Like suppose that the final product has been changed substantially from the through the processing, and the nature of the product has been completely changed, so it is not considered as the agricultural operations, right? There are many dilution, many modification, like canning of fruits, so it is a different, canning process is different. So there must be involvement of agricultural operation. Canning, there is nothing involvement in canning of the fruits. Fruits are as it is. So in case where the produce is subjected to substantial processing, which changes the very nature of the product, the entire operation is not considered as agricultural operation. So there is a need of proper differentiation in this kind of process. The profit here of received from the sale of such processed product will need to be proportionally distributed between the agricultural income and business income, right? So this is what one kind of exemption. Another is the income from trees that has been cut and sold as a timber is not considered as agricultural income. So here, because there is no active involvement of operations like cultivation, soil treatment, and so on. So there is no active involvement of agricultural operation, and that's why the timber production is not considered as the agricultural income. And so these exemptions which have been mentioned here, if anyone is falling inside in this, they will be subjected to income tax. So these are some important components which needs to be taken care, which are the agricultural income, which are not agricultural income, and you can go through these links where you can read about this, what kind of agricultural activities are going to be related to the agricultural income and will be exempted from the you can say the income tax. So this is all for today. Thank you, and we will discuss more in the next class. Thank you very much.